So which undervalued stocks are worth owning? It is Thrifty Thursday. Adam Bold, founder and CEO of the mutual fund store. John Morris, managing partner with Crestwood Advisors. John, I'll start with you. Got some bargains for us?
Do have some bargains for you today, Mark. A couple names that we really like and have strong conviction around. I'll start with Johnson & Johnson. After their consumer recalls last year and manufacturing quality issues, we look at 2011 as being a pretty bright year for Johnson & Johnson. The pharmaceutical side, the medical device side, stocks trading at 13 times earning, paying a 3.6% dividend. Good mid 20% returns on capital. We like that business. Another would be insurer Fidelity National. Also, they're a toll taker in the home mortgage business. They've seen an uptick in the commercial side and the refinance side. They've bought a lot of stock back, about 9 million shares last year, pays a 3.5% dividend, and trading below book value, which is extremely attractive to us.
Okay, let's hold on. Hold that thought. Let's get some ideas from Adam.
Well, I'm on the mutual fund side, as you know, Mark, and there's a few funds I like that are really good value funds. First of all, the Croft Value Fund, the Wasatch Income Equity Fund, and the Heartland Value Fund. And while all three of these funds have a different attitude about what the word value means, what they have in common is the fact that the managers have been able to deliver consistency of performance over the long term, and that is that they tend to do better when the market's doing well, and they tend to do better when the market's doing poorly.
How do they do that, Adam?
Well, I think it's through superior stock selection. You know, the reality is that in the world of investments, like any other business, there are some people that are just better at it than others. And, you know, I think that while there are 27,000 mutual funds in my database, the vast majority of those are, and this is a technical investment term, they're stinky. The reality is, though, that there are some people out there who have shown an ability to just be better at picking stocks than other people, and those are the ones that we want to go with.
Ray, let me just come back to where we started this interview, which was the clip of Ray Dalio that we played from Squawk Box this morning. A really successful guy, huge hedge fund. But his reasoning for buying the market was, one, because the Fed was pumping liquidity in, two, because the ECB was pumping liquidity in, and three, because you had fiscal stimulus. Well, this morning we've got the ECB raising rates, or talking about raising rates. We've got a whole discussion about whether QE will finish in June from the Fed, and there's talk of actually reducing the amount of fiscal stimulus on Capitol Hill. At what point, if at all, John, do you feel that the stock market will react negatively to those events?
Well, I would think we'd agree with Ray Dalio's comments that we're in sort of the short intermediate tail end of what has been a very strong market here. I mean, eventually the stimulus will end. We will start to see inflation. And if you don't own stocks that have pricing power, ability to pass off pricing, you know, that's really going to be difficult for...
So when does that happen? When does the market turn on those things, if it does?
Well, I think generally speaking, we would say that's more of a, you know, maybe late fourth quarter into next year. We start seeing that, and rates will rise, and that will be difficult for the stock market in our view.
Simon, I think that one of the keys, too, is the fact that during the dark ages, during 08 and 09, companies cut expenses, and now as we're seeing revenues increase as the economy gets better, the profits are turning out to be much better than many people expected, and I expect that that profits trend will continue for the foreseeable future.
Okay, guys, thank you very much, Adam and John. Thank you.